Our next guest does say that this Friday's inflation data will likely shift the odds higher of a July and September rate cut, supporting the summer of small caps, as he said. Joining us here at Post 9 is Tom Lee, Fundstrat Global Advisors, head of research and a CNBC contributor. Tom, it's great to have you.
Great to see you.
You want to start with what the political news or the economic news? What's more important to you, do you think?
In the short term, it's the political news. But really, in the longer term, especially into year end, it's actually the economic news.
Explain why.
Well, in the short term, markets are very sensitive to, especially the sector level, depending on whether it's a Republican or Democratic taking the White House in November, and then especially all the congressional elections and state elections. So I think that's what you saw last week, is as probably shifted towards Trump, small caps, industrials, financials rallied.
And you're sticking with that call, which is for what, 40% over 10 weeks?
Yeah, the overlap is small caps are very sensitive to a Fed cut, and really the probability of a Fed cut, that it's finally happening. And I think it's going to look like the October to December 2023 rally, which was almost 30%. This one should be bigger because of the amount of short positioning and the amount of oversold in the Russell. So, yeah, 40% by the end of the summer.
I just want to dig into it. Does it make sense that tech, that NVIDIA and Tesla and Microsoft and Apple and Meta should be outperforming as the odds rise for a Democratic victory?
Some of that, it's, day-to-day, it could be noise, because last week you had the biggest down week for the NASDAQ in quite a long time. So I think there is a bit of a dead cat bounce. But to me, I agree with you. I don't think that the FANGs are necessarily a Kamala Harris, taking the White House trade.
But there is some evidence of the fading of the Trump trade, as you mentioned. Russell's underperforming, Bitcoin weaker today, financials are lower, so are energy stocks.
Well, again, it's, the sell-off for the Russell started in the middle of last week. It's down almost 5%. It is a mirror image of what happened in October. After that first week rally, you had a 5% decline over 8 trading days, and then you had essentially a 25% rally for 7 weeks without a drawdown. I'm not sure that's any different today.
Is your long-standing optimism about deflation really changing at all? Do you expect any surprises on Friday?
One print can be uncertain, but I think the forces underway for inflation to fall like a rock are in place. The reality is there's a durables recession. It's in housing, and now it's in autos. That's like 60% of the CPI basket is in a decline until the Fed really injects confidence by cutting. And so I think there is urgency for Fed cuts to happen sooner. But at the same time, I think the effect on inflation is there isn't another incremental driver for new inflation. So inflation, I think, is going to surprise to the downside, and hopefully it's Friday.
Energy, same story. I know we've got gasoline futures lowest in a few weeks, and we broke 80 today on WTI. Brent's below the 200-day.
Yeah, I think energy's a tough trade in the near term, because as long as oil's under pressure, I'm not sure I want to be overweight energy stocks. And if there's drilling under Trump, that's downside pressure to oil. But over the next 3 to 5 years, I think energy is a great investment. But I think this year it's not really going to be the spotlight for us.